Welcome to the Leaders Insights podcast. Today's episode, Capital Allocation Under Pressure, how CFOs are rebuilding the investment case. Let's start with the uncomfortable part. Cost of capital jumped, growth stalled, and most CFOs responded by cutting travel budgets and freezing headcount. Cosmetic. What did the good ones do differently?
They stopped treating the portfolio as sacred. Here's the durable lesson. Every project you funded in the cheap money era was underwritten against a hurdle rate, the minimum return a project has to clear, that no longer exists. When your cost of capital doubles, half your approved projects are quietly destroying value, and nobody's rerun the maths.
That sounds like something everyone claims to know and nobody actually does.
Correct. It's the difference between saying it and doing it. Look at Siemens Energy. 2 years ago, they were bleeding on the wind turbine business, throwing capital at a segment that couldn't earn its keep. The turnaround wasn't clever cost-cutting. It was ranking every unit against a real hurdle rate and starving the ones that failed. The stock roughly quadrupled from the 2023 lows because they stopped pretending the old bets still worked.
But ranking projects is arithmetic. Why is it so hard?
Because arithmetic threatens people. The pet project belongs to a senior executive. The plant sits in a politically sensitive region, so the honest number gets buried under a strategic optionality argument, which is corporate for, we can't justify it, but we're scared to kill it.
So the enemy isn't the spreadsheet, it's the org chart.
Always. The best CFOs build a process that makes killing a project as respectable as launching one. At Unilever, when Fernando Fernandez took over as CFO and then moved up, the discipline was brutal. Fewer, bigger brand bets, and a public willingness to divest the tail. They put the ice cream business up for separation. That's not caution, that's deliberate reallocation.
Give me the mechanism. When you say tighter linkage between capital and value, what does that actually look like on a Tuesday morning?
It looks like every capital request arriving with a single line at the top. What does this return? Over what horizon? Against what hurdle? And who owns the number personally? Not the committee, a name. And then 12 months later, you check whether the promise held. Most companies never look back. They approve, they spend, they forget.
The post-mortem, nobody runs.
Right, and it's the cheapest thing you can do. A software vendor, on a plan, so treat this as a sales point, publishes surveys claiming fewer than 1 in 5 firms formally reviews whether capital projects hit their forecast returns. Even discounting their spin, the direction is obviously true. If you never grade your own homework, of course your allocation drifts.
Let me push. Isn't spend more deliberately just a slower way to spend less? Aren't you starving growth to look disciplined?
That's the trap, and it's the wrong reading. Deliberate isn't stingy. NVIDIA spends enormous capital, but every dollar is aimed at a return they can articulate. Discipline means you can spend aggressively, precisely because you know which bets clear the bar. The timid CFO spreads money thinly across 40 projects so no single failure is visible. That's how you guarantee mediocrity across the whole book.
So concentration is the point, not restraint.
Concentration behind conviction. If you genuinely believe a segment earns above its cost of capital, you should be uncomfortable with how much you're putting in, not how little. The sin isn't big bets, it's small bets everywhere, hedging your own indecision.
What about the CFO listening who inherited a portfolio built for 2021 rates and knows a third of it is underwater?
Then you're already behind, but the fix is unglamorous. Rerun every active project at today's cost of capital, not the one on the original approval memo. You'll find a chunk that no longer clears. Some you kill, some you fix, and the freed capital funds the 2 or 3 things that actually compound.
One thing they should do Monday morning, make it concrete.
Pull your 5 largest active capital commitments. Reprice each against your current cost of capital, and write 1 sentence on the return you still expect. If you can't write that sentence honestly, you've found your first cut.
Grade the homework nobody wants graded. Good place to stop. That's it. The CFO decision tools are live at mba-training.com.